Thanks for joining us on another For Investors by Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Wednesday of the month at The Point in El Segundo. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
Thank you guys very much for coming. I appreciate it. For Investors by Investors. This is the name of our group. This is the South Bay chapter, and it was all put together by a couple of full-time investors that were tired of getting the sales pitch each time, the boot camps and the book and tape sets and things like that, and no upsells or anything like that. So at any of our different chapters throughout Southern California, you will not get any kind of pitches. None of that upsell stuff. All our clubs are put together specifically for the networking, for the education, and to try to basically develop a group of investors that we can all rely on to help each other and develop relationships to help each other's businesses, because none of us can do this without each other. It's amazing how many resources there are in the room. And when Dave and I started this, and I started the Long Beach one, and Christina over here has done the Pasadena one as well. We have one in Orange County. And when we started doing this and all the chapter leaders started doing this, our businesses exploded, really, because of the relationships, just meeting different people in the room. And it's absolutely amazing what you can do just with the relationships that you develop in this business, and treating people right and trying to teach people and just help people any way you can. So that's really what our entire group is about. And each chapter is a little bit different. This one is more of a panel type discussion. My Long Beach one is more of a roundtable type discussion. Christina's is more of a speaker presenter type discussion, right? Okay. And all of them are more geared towards Q&A. This is going to be a Q&A as well. So feel free. We have questions here, but feel free to ask questions as they come up. Usually people are afraid the first 15 minutes or so, and then you start to get warmed up as we make fun of each other up here. So, that being said, we have a couple other things coming up, right? We have a holiday party coming up on December 7th down in Long Beach, so that will be up tomorrow. If you guys are interested, you guys can go to meetup.com and find our chapter here and RSVP again to that if you want. That'll be down in Long Beach. We do that once a year, and then we do a summer networking event once a year as well, so that'll be coming up as well. Dave, you want to talk about our sponsors?
Yeah, so the event that Matt's talking about, all the FIBI chapters, we currently have 5 active chapters right now. We all promote that event. There's no speaker. It's just a huge networking event. So it's a great place to go, meet people, and just, meet other investors. And as Matt was talking about, the quality of investor you become will be directly related to the quality of people you start making friendships with, right? So if you're meeting good people, you're going to become a better investor. It's just the way it is. So we've got that event happening on December the 7th. This group here in the South Bay, we always take December off because the event that we have, the date that we have for December always seems to kind of match up to the all chapter event. And quite honestly, Matt and I just need to take 1 month off of putting this event on. So our first panel for 2018, which will also be going up on meetup.com, it's a panel that we've never done before. It's called The Green Opportunity. And we're going to do a panel with cannabis becoming legal in California in January on the real estate opportunities in cannabis in 2018. And we're expecting to have a fairly large crowd, right? It'll be a lot of stoners, but we're expecting to have a pretty big crowd. So as soon as that event comes on, if you're interested in that, we've got 3 amazing panelists for that panel. One guy's a full-time investor, owns a very, very large apartment operation, and has made some substantial investments in the cannabis industry in both Washington and Colorado, and soon to be in California. We've got an attorney who specializes in the cannabis industry, and we've got someone that evaluates companies, and her specialty is evaluating cannabis companies. So if that's something that you have an interest in and an opportunity you want to learn more about, we hope to see you back here in January. As Matt mentioned, that this is a panel format. We've got three great panelists tonight. Those of you that have been to FIBI before, you know how we like to find people that are in the same industry but do different things, right? So instead of having the same person saying, "Yeah, me too, I do that also," we've got someone, Andrew here is a developer dealing kind of small multifamily. Dave's doing medium multifamily on the end here, and Mike's doing some really big projects. So we've got three different levels of multifamily investors. So we're going to cover kind of the range of multifamily. And if you have questions as the panel goes on, please raise your hand. We will get to as many questions as we can. This is a filled room tonight. So, if for some reason we don't get to your question and we're trying to move things along, part of coming to FIBI beyond the education is the networking. So after we're done here, we're gonna, as soon as we're done here, and we try to wrap up like right as close to 9 o'clock as we can. We've got to clear this space out, but we've reserved the patio at North Italia. So North Italia is the Italian restaurant just on the other side of the courtyard. When we're all said and done, if you go down this hallway right through here, there's a door back through here with a stairwell that you can basically get back around to North Italia. We've got, we'll have food. We actually ordered extra food just because we had such a big crowd tonight. Cash bar, buy your own drinks, we buy the food, and that's really where you're going to do some serious networking. So if you can stay for that, please do. These guys are all going to stay. So if we don't get to your question during the panel, come to North Italia. We can certainly answer it then. If your question is something very personal about your situation, save that one for North Italia as well. As Matt mentioned, we do have sponsors. That's kind of how we keep this thing going and how we afford all the food at North Italia for all of you. I know we've got, Jeff is here with UDirect. He's back there. UDirect IRA, if you guys are looking to use your IRAs to invest in real estate, these guys are a custodian. Any questions you have on that, find Jeff. I know Jason's here too. Jason's back there. Jason's with Spira Woodward, the very, very established real estate firm here in the South Bay. Jason, thanks for coming. I haven't seen anyone else, but Kyle Mealy with South Bay Tax and Financial Consulting is located in Hermosa Beach, is one of our sponsors. Farmers Insurance, Jesse Navarro, they're also in Redondo. They do a lot of insurance products, but they specialize in dealing with investment property. Andrew Westling with Walker Dunlop is a commercial lender. And New Western Deck, actually, you did a deal with those guys, right? Matthew here, who also is our first FIBI all chapter membership. So part of what you can, part of what we're rolling out starting for 2018 is we are going to be rolling out, instead of having to pay for every individual meeting, if you just want to buy like a pass that gets you into all of our chapters for the year, it's $199. For $299, you can buy a pass that gets you into every single FIBI chapter anywhere, any of the 5 chapters, including the all chapter events that we do in the holidays. So if, it's a great deal. Thank you. So if you're interested in that, see Matt or I, or actually just go on our website, forinvestorsbyinvestors.com. We also have a couple of corporate sponsors. More Financial is a hard money lender. And then Chase Law Group is another local real estate firm that actually helped us set up all of our entity. FIBI is a non-for-profit 501c6. So, the no sales pitch extends into our business plan as well. Anything else? Last thing I say before we do some introductions is, this is purely up here for our, for educational purposes. No one here is an attorney on the panel, I don't believe. And then Matt is a CPA, but he does CPA work about as well as he tans in Hawaii. I have 3 others too. I'm just going to break them out over the course of the event. Exactly. So this is not meant to be legal advice. It's not meant to be financial advice. This is purely informational purposes. This is, our perspective as investors and real estate people. If you've got specific questions about your situation, if you don't have those kinds of people on your team, you should. And if you need them, let us know. We'll point you to the right people. So with that, why don't you guys each just do kind of a 2-minute introduction, kind of tell us a little bit about yourself and what you're into right now. Andrew, why don't you go first?
Thanks for having me here. My second time here in the panel. My name is Andrew Raitt. I live in the Los Angeles area. I grew up in the Los Angeles area in the San Fernando Valley. I used to work in corporate America. I worked for IBM for a number of years, and then I just read a ton of books, and I just wanted to get out of the rat race, and I wanted to start my own thing. And I found real estate, and then I just absolutely fell in love with it. I started off by fixing condos, fixing and flipping them. And then in 2013, I built my first ground up construction project. It was a duplex. And then I found like, wow, I love multifamily, like really love this. And so it's been my passion and love making beautiful homes. And so, aside from investing in real estate, I'm really focused on doing ground up construction, a lot of development. I also sell, I'm not trying to sell anybody anything, but, I also sell some of the plans that we get done because there's a scarcity of like approved projects. And I also, build, small lot subdivisions and sell them throughout Los Angeles because there's a huge shortage of housing in Los Angeles. So I just focus on Los Angeles is what I know. There's so many rules and regulations in every city. And so, but I look forward to being a little more like these guys here. So I'm looking forward to learning as well because I want to start building my larger real estate portfolio.
Perfect. Mike.
Hi, I'm Mike Flaherty. Matt, Dave, thanks for having me. I think third time. I've lived here for 20 years, Manhattan, Hermosa, Redondo, but now I live in Northern California. We've been up there 4 years. So it's been a fun change, although we miss the beach and miss friends. Let's see. I've been doing multifamily for about 9 years post-recession. Prior to that, I was a developer. I've built probably 2,000 plus semi-custom homes for Toll Brothers. I did some hospitality resorts in Costa Rica and Dominican Republic and all these cool, sexy things. And then the recession hits, and for a lot of people, it brings everybody back to the basics of prudent investing and what's next. And I studied a number of different assets because I had done a number of different things, and it took me to apartments and multifamily. So I jumped in with both feet, absolutely hooked on it. I'll probably say it again, but apartments are the most risk-adverse, inflation-adjusted cash flow stream that you can invest in, period. They do well when times are good, and they do pretty well when times are rough. So myself and my partner, we have about 3,200 units nationwide from Seattle to Virginia. Current portfolio is valued at about $260 million. I started off flipping homes, and I had a nice corporate job and doing some development and some entitlements, trying to figure out what was next. And we've had a nice run of multifamily, and we think there's more to come.
Dave.
Yeah, I'm David Jankowski. I own and operate Revere Investments. We're an apartment investment company based here in PV. We operate all over Southern California in the space of 10 units up to about 100. We buy them, renovate them. Sometimes we sell them. Sometimes we refinance them. The way I found my way into this business, maybe I call myself like an accidental entrepreneur. I used to work for a company that was advising pension funds on their commercial real estate investments. And I worked for 2 different companies in that industry for about 11 years. And I was working for a company in their regional office down in Irvine, and was comfortable doing that. And the partner I'm with now had been kind of bugging me for a while. Hey, why don't we start up a company, do this investment stuff ourselves? I said, no, I've got a comfortable job. I got a company car. Why would I ever want to do that? And so then in late 2001, the company shut down the office in Irvine, and I was all of a sudden didn't have a job and thought, maybe it's a good time to get started with something now. So we started this just pretty much from scratch in 2002. Like in an executive suite office, just kind of looking at each other, thinking, okay, what are we going to do now? And another buddy of ours said, hey, you might want to start looking at apartment buildings. So we literally started looking at them, meeting some brokers and introducing ourselves. And we bought our first one in June of 2002, 52 units in Montebello, and have been doing more or less the same thing ever since. We put together groups of investors. We raise a few $1,000,000 for each deal, get a loan, fix it up. We've got a management company that takes care of the day-to-day stuff for us, and go from there. So it's a job, a business anybody can start, and keep at it, and you'll do well.
Thanks, Dave. My name is Matthew Owens. I'm a California licensed CPA, and I still know taxes quite a bit, even though I don't do them anymore because of guys like Dave. They bring me trash bags full of receipts that I just not worth my time anymore to deal with. But I do help a lot of clients with their tax and legal structures and things like that, just for free on the side to kind of help them get an understanding of what their capabilities are, what they should or shouldn't be doing. I flip about 10 houses a month. We've flipped over 600 houses now in the last 10 years. I buy a lot of value-add multifamily properties. I do private lending. I have a short-term rental business. We do quite a bit of different stuff. We invest in a lot of different syndications and things like that as well. And it's a lot of fun. It's hard work, but you know the relationships are what keeps it all going, and you know good marketing systems and things like that in place to continue to acquire houses. We own a renovation company and a property management company and a real estate brokerage on the ground out in Memphis, Tennessee, where we do most of our stuff. I live here or down in Orange County now. I used to live in Redondo Beach and had a 2-year-old, so my wife's family was down there and I needed babysitters. So I had plenty of babysitters down in Orange County area, and so now we live down there, and I commute up here, and I still run the Long Beach Club as well. So love doing this for a living. It's a lot of fun. It's a grind sometimes, but it also you can really see the true financial freedom that you can make out of this once you start to put more tools on your tool belt and learn the different strategies for investing.
I thought you moved to Garden Grove to be closer to the coffee shops.
Yeah.
Is that not right?
Yeah.
Right? Okay.
Coffee shops. Yeah. Never been to one of those.
Anyone who's laughing at that, you know. David Koch, co-real estate team. My day job is I'm a local realtor. We work with a lot of investors and homeowners here. We specialize in dealing with distress, which when you're dealing with investments, that's really what you're looking for, is you're looking for distress and then trying to undistress it and then sell it for a profit. As an investor, I've done everything from high-end fixing and flipping to real estate notes. I really like the debt side of real estate, to investing in syndicated commercial deals. I always say that there's for those of us that aren't full-time investors like these guys, if you're a casual investor, there's no one way to invest. It depends on what's happening in the market, what's happening in the cycle, and trying to find opportunities that are cycle relevant. And that's what I try to spend a lot of my time looking for, as opportunities. And it's why I run the club. It constantly exposes me to different ideas. We're also always on the lookout for real estate talent. So if you're into real estate, you're looking to get started in real estate and just don't know where to start, if you've got time, and you've got passion, let me know. Through my network, there's always people that are looking for people, would love to talk to you and meet you. So we're going to get started. The first question we have, and Mike, I'm going to give it to you because you kind of touched on this a little bit, is talking about why multifamily versus other real estate asset classes. Now, I know you mentioned the fact that it does well in recessions and not in recessionary times, but can you just expand on that a little bit and talk about why it does that versus other asset classes that don't?
Well, I think number one, private real estate has outperformed the S&P 500 forever. So, you're in the right place learning about the right thing. Why multifamily? I touched on it before. I've done a lot of things, and the recession hits, and you want to go back into something that's kind of safe and secure, and that's what apartments are. And to be honest with you, real estate wealth, it's not made in 3 years, right? There's a lot of people that expect to get rich in 2, 3, 4 years. It's very hard. Real estate wealth is a long-term wealth strategy. It's made over time. And that's the beauty of what apartments really are. They're a great long-term wealth strategy, and they're not based off of appreciation. They're based off of cash flow for the most part, like a bond versus a stock. And there's a lot of security that comes with that. The reality of it is people need a place to live. So now, everyone wants to know, where are we in the cycle, right? We're definitely up there. And it depends on what market you're investing in. You're local, all your deals are in LA, right? So are most of yours, right? So we're investing, Seattle, Reno, Richmond, Kansas City, Texas, Richmond, Virginia, and every cycle is in a different spot. But the reality of it is apartments do really well now because there's jobs, right? Job growth is up. Wages are a little slagging, but improving. The millennials are getting jobs. So multifamily does great. But when things get bad, multifamily still does pretty well. I mean, when I started buying in 2009 in the depth of the recession, we were still buying 100% occupied apartment buildings. Most people don't really, I mean, obviously real estate was a four-letter word coming out of the recession, right? The average foreclosure rate of apartments was 0.5%. They're not the types of assets that go back to the bank. And when things are tough, people need a place to live, right? The millennials right now, and Dave cut me off if I'm talking too long, but the millennial generation is 80 million in size. It's the baby boomer generation, which everyone knows about, is 75 million. So the echo boomers or the millennial generation are larger than the baby boomers. 70% of them rent. That's huge. And 30% of them haven't even graduated college yet. So when you think of, hey, where we are in the cycle, I don't know. It depends on the market. But there's a lot of demand that's still coming our way. And I think in a nutshell, that's why we like multifamily now and going forward, both in the short term and the long term, to be honest with you.
Dave, what about you? What is it about multifamily that brought you to it?
Yeah, so I'm more focused on multifamily, just more here in like LA, Orange, Southern California metro. And there's some special things going on around here. I mean, all of the stuff Mike said I would agree with, but if you just drill down to where we all live here, there's certain special things in California. I mean, first of all, you read a million times in the newspaper, right? There's this housing crisis around here where they're not building enough housing. It's totally true. And, I mean, you can profit from that. And there's a shortage of supply, a huge demand. So the rents are going up much faster than inflation around here. And apartments are not going to, or housing isn't going to get supplanted by something in the sense like a shopping center. You have e-commerce, which is killing off demand for shopping centers. So that's a whole real estate class that's really suffering badly from a change in technology and all. Office buildings, they're sometimes good, sometimes bad, but they're more shaky. Industrial buildings, that's the other big property type. They're doing pretty well around here. But anyway, apartments, shortage of supply and demand. You get Prop 13 protection as an owner. You get depreciation for tax benefits. But yeah, people need a place to live, and when there's a shortage of it, the rents go up. And it's not that much more complicated than that.
Andrew, I know you started off as a single family, and I know you still do some of that, but mostly multifamily or, multi-single family projects. Why for you was building that, why did you evolve into that versus single family stuff?
I generally take the approach, even with my single family projects, the multifamily approach. Well, one of the things that you hit on, Mike, is the aspect of you're working so hard and all of a sudden you just lose it all, right? And I've been through a recession and I lost everything. And in Long Beach, I was living in my best friend's living room, right, for a little bit. And so, I don't want to happen that day again. So when I underwrite deals, I look at them and I go, can I rent these out? Can I pay really expensive capital, right, to finish them and to rent them and still cash flow? And if I can do that, then this makes sense. So I wouldn't have any problem building out 18 single-family homes, right? But I mostly focus on apartments. And the reason why is because long-term, you have this stable cash flow. It's a business. Each apartment you buy, it's a business. These guys own lots of businesses. And they all have their own profit and loss. And there's depreciation benefits. You talked about the tax Prop 13, which is really beneficial. If folks here invest in other parts of the United States, they don't have that kind of protection in a lot of states. Being able to have your taxes locked in, that's a huge way of avoiding a lot of risk.
And the taxes are typically with apartment buildings are by far the biggest expense category that you'll have.
And so one of the reasons that I still like development, and if I have an opportunity, guys, to buy an apartment complex, in Los Angeles, it's very hard for me to buy apartment complexes because of rent control and the aspect of being able to have these lawsuit groups coming after you for displacing folks, because they don't have to leave in the city of Los Angeles unless you're tearing it down and then you're building new. But when you're building new, it's a very different tax base. versus if I went and sold it. And so I'm starting to keep a lot of projects. But long term, that's what I'm looking at. I'm not looking at just trying to, be a winner next year and all of a sudden I can just take off to some foreign country and live the rest of my life. No, I mean, I want to continue to build apartments. I want to literally do a lot more of like what the rest of the panel is doing and hold on to some longer term assets and creating value over time, coming in and improving assets. Because a lot of the apartments are owned by mom and pops, still throughout the country. And so you can come in and put processes and procedures as a professional business, right? And Matthew takes some of the same approach when he comes in with the way he runs his business, as folks that just kind of just, hey, I'll own this on the side, really taking a real business approach. And the truth is anybody in this room can do it. And you can start off with a duplex, or you can even buy a single family home right now, guys. In the state of California, they recently passed a law that allows you to build an accessory dwelling unit in the back. So now all of a sudden you can underwrite that single family home deal differently than your competition can. And then you have a duplex, and then you get another duplex, right? But I just like the long-term aspects of having the cash flow. And if there's appreciation there, it just makes it easier for me to finance it. And then also in 30 years, how much debt are we going to have on these projects? Not much at all, if none. So
Mike, you mentioned that you're investing in different spots all around the country. Like, what do you look for when you go into a new market? Like, why Richmond or Seattle versus, Southern California?
Yeah, if I could touch on one thing, that we have like 1,000 investors. We just did our quarterly distributions and sent out 1,000+ checks. So we have a lot of good communication back and forth with our clients. And one of my clients yesterday, the guy's in like 8 deals. He sent me an article in the Wall Street Journal. If anybody wants it, grab me. I'm happy to email it to you. And it was talking about how the growth of the single family home market is affecting multifamily and rentals. And if you really read it, I found it to be more positive about apartments and rentals than about single-family homes. But it had a couple good things I think just that'll help everybody. One, housing formation is decreasing. Okay, that's not good for the single-family home market. We're not talking about LA, we're talking about the country as a whole, right? Home ownership is down to record lows. It's significantly below the historical average of 65%. It's expected to stay there. Let's see. Single-family home ownership, with most economists, I just spoke at an event in Seattle at the convention center. There's 2 economists there. They expect single-family home market to slow down because you have a couple more things going against it. You have rising interest rates. You certainly have affordability rates, right? You have it here. You have it in Seattle. Most markets across the country are becoming more and more affordable to buy the American dream, the 3-bed, 2-bath home.
You mean less affordable to buy?
Sorry, less, yeah. And then you also have this tax code overhaul proposed by the Republicans that theoretically could reduce tax incentives. So most economists are expecting it to slow down. Supply, there's a lot of new construction, both on the single-family side and the apartment side. But the reality of it is, as we talked about with the millennials and the Generation Y growth, there's just more demand. Since 2010, household formation has outpaced construction by 3.5 million a year. That's significant. So, the one thing economists are looking at that could change this is, when are the millennials going to start to get married, right? When does that start to impact the rental market? But as I said earlier, 30% of the millennials are still at home or in college. It's a ways out. So big picture is just some of the facts that why we love apartments. And I'm happy to send anyone that article. As for different markets, point blank, we look for jobs. Job growth, job announcements. If anyone owned homes when the recession hit, it was those of us, and I probably had 12 homes when 2008 hit. And, some of them did great, some of them did not. If they were, had a condo in Park City, if they were a second home market, you got hammered, right? If you were out in an area of construction and supply, Inland Empire, you got hammered. If you were close to jobs, probably did okay. And it's the same thing with apartments. Regardless of where that market is. So I hire an economist and demographer every year to make sure we're looking at the right growth markets where one, we can still provide our investors really attractive returns and cash flows, but two, markets that are solidified by job growth, job announcements. And, we're investing in Seattle. What's going on with Amazon is crazy. It's expected to be top 5 in rent growth over the next 5 years and has been for 20 years. We invested in Reno last year. Tesla just, their gigafactory is under construction. The place is like the Wild West. It's crazy the growth that's going on there. That building is going to be as large as the Pentagon. Google just bought, early this year, 140 acres next to that. They're going to be building their autonomous, we hear they're going to build the autonomous manufacturing plant there. So those are as an example, I don't want to go on all day, but those are the types of stories we like to look for in the markets that we invest in if we're going to go outside of our home market.
So you're looking for larger, stabilized assets or value-add type assets in these markets where you see a substantial amount of job growth in those areas is what you're focused on mostly?
Yeah, exactly.
Okay.
And I've never really talked about that, but we're not buying distressed assets.
Okay.
We're buying stable performers. We're buying deals that are 90, 95% plus occupied, which means stabilized. And they have been, many of these assets had similar occupancies in the recession. You had a question?
Yeah. It's a little hard for me to tell, but are all of you, it sounds like, Mike, you're buying existing properties, but it sounds like David and Andrew,
No, we buy only existing properties and fix them up.
Yeah, that's what's cool. They have completely 3 different strategies here that they're deploying, which is great for the panel. And I think, one of the biggest issues is, that you brought up was the rent control here in California. Seems like that might be getting pushed more and more, and maybe even in Seattle as well, given the push in these markets for that rent control type basis, which may be one of the key things that are detrimental to multifamily in certain segments of the market, right? And what's interesting too is what you're saying about the millennials, a strong push towards the multifamily side is, so many of them are graduating college with massive amounts of debt. So they can't buy, and they can't get rid of that debt either, obviously. So, with that being a big push, that is going to really take away from single families and push them towards multifamilies as well. So, Dave, you focus on a completely different strategy than the larger stabilized asset class, right? And so what do you typically look for in a deal? What's your acquisition strategy?
We're just focused on the Southern California area, and so the decision for me is sort of like, well, what cities and areas around here am I going to focus on and just chip it down that way? And I think right now we're going to stay focused on some of the better areas. I mean, we own in Glendale, El Segundo, West LA, Belmont Shore. We have one down in Los Alamitos. We have one in Anaheim. Places where if you do a really nice job fixing up the apartment, you can attract a higher income tenant profile who will pay you a premium for that nice unit. And around here, if you're in a good area, you'll have no problem doing that. We try to position ourselves with our finished product kind of in between brand new property and all the old like 1950s and 60s buildings that haven't been upgraded at all. So there's some places around here I think are totally overhyped, like Inglewood. A place that I think that isn't overhyped, I'd recommend, you want recommendations, place to go if you're thinking of investing, I'd say Santa Ana. Go out and check that. It's great. I mean, it's right in the middle of Orange County, a lot of jobs down there, freeways, and things are reasonably priced. So you just got to be careful about where you're going and just make sure that there's that ability to attract that person who's willing to pay you the premium rent, because that's how you can make money in value add in this market.
And then hopefully we'll answer your question, Jeff. Andrew, you do something completely different, obviously, with the value add, but you're looking at the development aspect of things. And what does an ideal project or acquisition look like for you when you're looking at the development side of things?
I mean, it's going to change from year to year because you're making me think I should probably hire an economist on some levels as well. I do spend a lot of time doing research. I'm really big on patterns, and when you really pay attention to a lot of data, it starts to tell you things, right? So we have some massive concentrations in Los Angeles into two areas that offer very rich density and also very high income earners traditionally, and more traditionally now because of all the advent of the digital community and also media and the funding. So we have a high concentration in Hollywood, and then we have high concentration in downtown Los Angeles. And so a lot of people have kind of pushed into those projects. And now they're getting bigger and bigger because literally the land's so expensive, people have to get bigger. So it can change. I'm looking back in kind of the history of some of the projects, and some of the best performing projects that we had. Now this is when we kind of built them and then sold them, have been projects where they're really simple. They're literally detached. In the city of Los Angeles, if you're building, under the residential building code where you're just building 2 units, and then 2 units and 2 units, you have one inspector. It can go really quick. We've done projects in less than 10 months from start to finish, and some even less than that. And so it's like, wow, why don't I just do those all day? The reason why is because people need housing. And the long-term opportunities, the sacrifice, maybe we'll spend an extra year, but the potential long-term upside is worth it for us. So right now, the biggest project I'm in construction on is a 9-unit full subterranean garage. A lot of great experience we got with that. We bought the land for $390,000. And so I built to the max 12,000 square feet. I underwrote the rents at $2,300, $2,200. They're over $3,000 now. I just could not believe it, right? So we tried to be conservative, and it just changes year by year. But I'll still buy a smaller apartment if I can get it delivered vacant. Right? If I can get it vacant, I'll come in and I'll remodel it and I'll make it look so cute and wonderful. Everybody's like, I love this place. And they want to move in. And so we're very passionate about that. But if we can, find something that makes sense, again, we have to be really conservative. We have to be super conservative. And so, we're talking kind of in the hallway over here about different ways people underwrite deals, right? What are you going to buy it at? Like if I can't build into like a 7 cap or a 7.5 cap, I won't do the deal because there's external risks that are out there that we don't know about.
Can you offer a little more explanation of what that means?
Yeah, and so your explanation was really good. And you talked about whatever your net operating income is, right? Based on, and then that into how much money you put into the project, total, including interest, everything, right? And then you find basically what I look at is a yield on your cash. So if I put $1 million out there and this is before any kind of, loan payments or anything like this. Is just what it pushed it. So let's just say it's making, I don't know, $70,000, right? Or 700,000, that would be crazy. But at 70,000, that would be a 7 cap, right? And so just depending on how much money you have into the project, and then you can layer financing to them. I mean, right now, healthy numbers, people building into them are a project that would be like a 5 cap, and that can still make a lot of sense, and you can cash flow and you can get financing from a bank, and so it just depends on the project.
Andrew, and also before Dave, you answer that, can you also talk, because I know you do a lot of the small lot ordinance work. Can you kind of explain a little bit like what that is and why you like the SLO projects versus some projects where you're building apartments?
So just to let you guys know, I've been moving away from the small lot subdivisions because there's a lot of pushback in the city of Los Angeles from like angry neighbors, not in my backyard. And you'll have people that are protesting you and people that are suing you for just because it costs $75 to file an appeal. So I do a really good job of my community outreach. I pick projects that aren't contentious for the most part. And I've gotten over 120 small lot subdivisions approved. So, but I like them because you're on existing multifamily lots. And what's happened, the rents have gone so crazy in Los Angeles, they've gone up, that people have been moving away from the small lot subdivisions, which really sucks for the millennials. Because what it's doing is not giving them home ownership opportunities. Okay? And so now all of a sudden there's such a shortage of apartments. And when I say there's a shortage of apartments, I'm not just talking about like, there's a shortage in downtown LA or Hollywood. I mean, across the board. And that's why I focus on working class families. I focus on areas where they don't have new apartments. I'm like the first apartment in 30, 40 years. It's like incredible. Like they're like, what are you doing? Right? And then, so it's kind of sad that there has not been that kind of, but what's interesting now is that you're building these apartments in areas where people really, really need to live because they literally work a few blocks away or they're like 3 exits away on the freeway. And so it's very desirable. And believe it or not, we're getting rents that we never thought we can get. We were always trying to be conservative and going with what the market was and maybe putting a little premium on it. But then brand new construction, you put vaulted ceilings, you put nice finishes, people pay you a premium. And I've tried to focus on bigger units, right? Like 4 bedrooms, 3 bedrooms. And people think, why do you build them so big? Don't you get more per square foot when you're renting smaller units? And yes, that's true. But long term, the market really wants to have bigger units. And there's also roommates. I don't know about you guys, but I love to save money. And when I got out of college, I had a ton of roommates. And we saved and saved and saved, right? So, believe it or not, a lot of the renters, they're millennials, and they're roommates. I mean, we do a good job on checking their credit. And so, almost all my apartments are 3 and 4 bedrooms. Almost every single one of them. And so, we try to focus on that. But the small lot subdivisions offer a great opportunity that if you can buy it right, and first of all, you have to buy it super cheap, the land super cheap. And then you have to basically go through the process and know how long it's going to take. It takes about a year to a year and a half to get your final approvals. That's a long time to hold your breath, right? And then you have another year to a year and a half of finishing up the construction, your final maps. And right now, the city of Los Angeles, if anybody's building new apartments, city of Los Angeles, is taking about 8 months to 14 months to get all of your utility infrastructure in place. So you better get on that immediately. God bless you. And so it's causing ripples through the marketplace right now. It is making it difficult. But I look at it from a backstop perspective. If I build one of these small lot subdivisions, whether it's 4 units or 18, I can rent them out. And in North Hollywood, I could rent one of my small lot subdivisions that has like a vaulted, has like a 20-foot ceiling on the 3rd floor. I can get like $3,600 a month, and that's a good deal for 3 bedrooms. And someone can rent the bottom unit.
What does that look like on a cap rate type scenario?
So we'd be building in like 8.5.
8.5 cap in California.
Yeah, all in everything, including interest, expensive interest.
And when you're adding value to these, what do you typically look for as far as what looks like a good deal to you?
Yeah, we're going to like a low 5, actually. So we'll go and renovate these things and look at our numbers. Basically, the stabilized NOI, which would be all the rents up at the post-renovation rent, small vacancy factor, stabilized expenses, and then we divide that by our total basis. And I feel like if I can get to call it like a 5.25 or so, I can finance that with a takeout loan, put like a long-term 5-year loan or so on it, and that'll cash flow nicely. And I can pay my investors over the preferred return typically with that. And so it takes the pressure off of me as a renovator to sell it really quickly. Because you don't want to get caught if you're in this business where you have a loan coming up and you have to sell. You want to be able to hold on and set the sale time on your own schedule and not by a lender telling you, hey, I want to get paid back. You can't get a loan that's big enough to take that out. And then you're stuck having to sell your way out of something in a time that you don't want to. But yeah, we're about a low 5 is where we go on the rehab. But the interesting thing is it's different than Andrew in the sense that he's riskier, right? I mean, you're building something. There's a construction risk. It takes more time. You don't know what it's going to be. I mean, we can renovate these buildings in maybe, depending on how big they are, a year, a little more than a year. And I got a pretty good sense that the interest rates will probably be about the same. And I know about where my rents are going to be. We've done this enough that I get a good feel for it. I'm comfortable with that return for that much risk I'm taking.
And I think that's, absolutely key. Andrew, that's why you sell some of these off, because you're tired of waiting so long. It's like, hey, leave a little bit of meat on that bone and get your money and walk after taking all that time. And, because a crash could happen right in the middle of your construction project, right?
Yeah, by far, we've made like much more margins on development projects. I mean, by far. If I can just only do developments, but I'm realistic. I'm realistic that that's a really risky business, and that's all you're doing is only developments and selling off your plans and permits and entitlements. You have to go in there, and if you guys do a project, I highly recommend that you have the ability to execute all the way through, or you don't take anybody's money. That's what I recommend, because you may just have to do that. And if you're not prepared to do that, then you're prepared to risk your investors' money. That's my opinion.
And, I think, Dave, you brought up a good point about the financing aspect of things. Mike, on the larger stuff that you're dealing with, what is the financing on the three different types of what you guys do, are far completely different, obviously. When you're dealing with the bigger stuff, what are you seeing as far as rates, terms, down payments, for that type of project?
So when Matt says bigger stuff, we bought as small as 30 units. Just this year alone, we bought a 436 unit deal, which was massive, a 434 unit deal. These are in Kansas City, all value add plays, but they were 95% occupied when we bought them. And then we're buying some smaller West Coast deals, 52 units and 97 units. We've been buying some West Coast deals, 30 units and 40 units.
But the dollar figures are comparable, right?
To some extent, they can be, right? But from a financing standpoint, again, I used to be a developer and do some single-family homes like many of you have. Financing these apartment deals is pretty basic. The banks love apartments because they are solidified by cash flow, right? It's not a single-family home where you lose your tenant, you're vacant, and you don't have enough rent to pay for the mortgage. Same thing with a fourplex, right? You lose two tenants, you're struggling to pay the mortgage. The larger properties we love, you lose two tenants on 100 units or 50 units, you're still doing great and cashing checks. So the banks love apartments. It depends on what's called the debt coverage ratio, on how much leverage you can get, which basically is, a ratio of how much cash flow the property generates compared to the debt that a lender will give you. So on some Midwest markets where we're buying at a higher cap rate, we'll get a little bit higher leverage. So normally we can get 80% leverage on most of our larger deals. On some of our smaller deals, they're a little bit more value add oriented where, we're doing, it's not as risky, Andrew, as what you're doing, but we'll go in and we'll remove the tenant base and we'll double people's rent. We've done 2 of these deals in Seattle where we've doubled the value of the property in 2 years. But we're not going to get as good leverage on that because there's a little bit more risk associated with it. So those deals will get 60 to 70% leverage. And we'll add a lot of value over the first 2 years, and then we'll refinance into long-term fixed rate loans and hold on to it for a cash flow.
And what are you getting on those long-term type loans? What kind of rates and terms and stuff like that are you seeing on the long-term stuff?
Long-term is we're getting 80% pretty much across the board. And, interest rates are in the low 4s. Right now,
and usually we'll get 5, 7-year terms, 10-year terms.
We like 7-year terms.
Okay.
Because again, our investors, they're owners in each property. As Andrew said, each property is its own company. So if you're an investor, you're a pro rata owner in the deal. You get all the tax advantages that come with it. You get your share of income, expenses, and a great long-term cash flow stream.
And then your debt service coverage ratio is around, what does it need to be for the banks? Around 135% or something like that? Or what are you seeing?
West Coast markets, curious what you're seeing on your deals, but we're seeing 1.2.
Okay.
And then most of our deals are more around 2%.
So for those of you guys that don't know, debt service coverage is basically how many times your income is 135% more than your debt payment, basically your net income. So they want to see that it's at least making 120% in California and or in some of the West Coast markets. Question over here.
Well, it's a great question. So again, we're about cash flow. So we don't necessarily put people out. One of the most interesting things I learned about apartments is that the average turnover rate with apartments is 50%. So if you have 100 units, you're going to lose half of your tenants every year. It doesn't matter what you do. It doesn't matter how nice the property is or isn't, how well you market. That's the national average. So because we're more cash flow focused and we're more risk adverse, we don't renovate those units until someone moves out. But there are sometimes we're raising rents so high that it increases our vacancy, which gives us the ability to renovate units faster. And to Andrew's point, there's a lot of these markets that historically are more affordable. But we're seeing in this market, they're becoming more in demand because people need a place to live. So if you can go into some of these historically affordable markets that are still safe, still have good access to jobs, there's a lot of opportunities where you see properties that just aren't renovated, where there's no apartments that have a consistent appliance package, nice countertops. We're adding washer dryers in almost all of our units. On the larger properties, we're renovating leasing centers and putting Starbucks cyber cafes. We're adding dog parks. We're doing technology packages on our interiors with keyless entry and USB ports and smart thermostats. And, these are things that tenants are looking for in 2017. It's a great question.
And
we're not evicting people. We can't. Yeah.
Are you seeing any Fannie Mae, Freddie Mac 30-year fixed rate money at all for any of the larger projects you're doing?
No, I mean, all of our money's coming in through Fannie Freddie. I think we do 7-year holds, so we're not looking at that product. Okay. But I know we did one 15-year deal. I know
it's one of the scariest things when you're investing in multifamily is when you're used to the single family side, all of a sudden you're like, I got a 7-year window. That doesn't seem very long. That doesn't sound like retirement to me. That means you got to refinance again. So I always look for the long-term stuff. But, that's one of the things that people have to get used to with the financing. Question over here, and we'll come here.
My name's Joe. I'm from Capital. You can get long-term Fannie Freddie program money, but most people don't because it's more expensive and it doesn't make sense for the business model. But if you a quiet family that just wants to pay for 30 years, you can get a Fannie in 30 years.
Okay. And the life products really, I don't know if you've sourced any of the life product, but a lot of big family trusts, and they're buying a lot of these big family trusts have made billions of dollars on apartments for the same reasons we're talking about. And they normally they'll put as long a fixed rate term as they can get on it.
Yeah, but the life company will, to reduce the risk, will accelerate the amortization. They might only give you a 20-year amortization and put a 20-year fixed loan for the whole time.
Question back here.
So if you have someone right now, how we figure it, somebody that's being they say, I really like how do I
So question is, how do you go from being maybe a 2 to 4 unit investor to starting to scale up? Why don't you take, I know that was kind of how you guys.
That's what we were doing. I mean, we started off a little bit bigger than that, but that's a great question. There's no straightforward answer to that. Business is about deals and money. So you got to be able to find the bigger properties. There's no reason you can't do them. I mean, it's theoretically, there's the same amount of brain damage to buy 100 units as it is to buy 5 or 500. So you got to say, what am I going to focus on? You got to start somewhere. Say, okay, I'm going to look for 50 units or 20 or just narrow yourself down. And then you got to find money for it. There's the debt and the equity side of the business. The debt side, getting loans, that's very well organized. There's lots of mortgage bankers out there, and it's all fairly straightforward. But then you've got to get the equity for it. And you need investors. You're not going to put your own money into these things and finance all the equity yourself. And so how do you find investors? You can't find investors without a track record. You can't get the track record without the investors. It's like a chicken and egg type of problem. So I'll tell you the way we did it. So we didn't have a track record when we first got started. And we got introduced, I guess luckily now, we got introduced to a guy who had a Rolodex of high net worth investors who basically trusted me and my partner that we more or less knew what we were doing. And he raised most of the equity for us, and in exchange for that, we gave him a piece of our profit. And that went on for about 3 or 4 years worth of deals. And that allowed us to get enough equity in to start doing like call it 20 to 100 units in the LA area. And after the recession, we had got enough of a track record that we went out and sourced our own investors. We've got some wealth management companies now who we work with in addition to just individual people that we know. And we don't use that other guy anymore. We don't have to split the profit with him. So I can make a lot, I can make some, I make the same amount of money, but I can do smaller stuff. So that's how I'd answer that. It's hard. It's really hard, but you can do it.
I want to take a different approach on that. So, for example, when you're out at this restaurant afterwards, you say, "Hey, David, can I come work for you for free?" Right? I'm serious. Or can I be an analyst for you on deals that come over? I can take a look at your Excel format. I can help you scrub the numbers. I can help you spread them. I can help you basically however they normalize their rents, right? Mark to market, how their expense ratio, how they turn over the units. And then all of a sudden, you're kind of showing him that you're willing to put in the work, right? And then, or somebody else, right? And then now all of a sudden he's like, yeah, that's interesting. Hey, can you fly out to Atlanta on Saturday to go look at this project we're looking at, right? You're like, no problem. And you're not asking for a check the whole damn time. You're not asking where the upside is, any of that. And you're just excited to get the experience. And while you're out there, you find some other stuff. And you're just being proactive. It's kind of more like a little bit of a street hustle, like to just get out there and just do it, but not in a negative hustle way. Like one of the things I did, because I wanted your guys' experience. I knew I wanted to do multifamily, but I had just literally only flipped like condos and done some single family homes. So there was a guy named Scott Richter, and I said, Scott, man, I'll work for you for free. And I was meeting him at 5:30 and 6 in the morning, like, cause that's when he got done exercising. And he was sitting there explaining things, and I work on the weekends, and I was going out to some of his apartments, and I was willing to do more, but then he moved to another company. But he saw that kind of confidence. He started introducing me to investors and said, this kid's got something. And that's how you just kind of just get started. But it's going to be a lot of sometimes free work with somebody who's going somewhere already.
I agree 100%, except I think you should have asked for the flight cost if that happens. So if they're asking you to go out to another market. But no, in reality, like there are a lot of people that do multifamilies consistently. And there's a lot of people that say they do and then they don't, and then you're running deals for them and you're not actually closing and things like that. And, doing that extra work, now you are building your own track record by doing this and by working on those deals with people. Whether it's, hey, you find somebody that's you're gonna help analyze deal after deal after deal and bring you stuff, and you're gonna learn along the way how to analyze this stuff, and what the numbers are. It's all about the numbers and at the end of the day and the economics of the deal and things like that. And so, if you start to really understand the financing side, how to raise the, capital and how they're raising the capital and how that's working, how they're presenting the deal to the investors. If you don't have the knowledge base to be able to break down the numbers to your investors and to be able to show them where every risk is, or as much as you can, and how you address that risk or how you're trying to mitigate it, and then present it to them in the right light, you don't have a chance of raising the capital for it in the first place, right? So it's always better to try to piggyback off someone else's experience and give away that free time, because you're basically just paying for your own education right there and building your own base. Now, if you go do 4 years of deals with somebody, he just built his own track record by doing that. And now he has the basis to be able to say, hey, investors, I've been doing this for 4 years and here's all my deals I've been working on. That's like the best thing I think you can do, is that type of relationship. Yeah. In the beginning when I was raising capital, you got to fake it till you make it, really. You go to I was going to 4 networking events a week to raise capital from investors before I just said, okay, now I have too many investors and I'm trying to find homes for their capital and things like that. But, at the same time, in the beginning, when you're first getting started, I didn't know anybody with $35,000 that could invest in something, let alone, anybody that's going to put in $1 million or more into a deal or put a large construction amount together that is going to trust you to do the right homework, that you've done your work correctly. It took 10 years to develop the relationships that I have now, or that some of these guys have that have been doing this, and now the same investors will continue to refer and refer and refer, and it becomes a windfall effect.
This concept can be applied to finding deals as well with the brokerage community.
Yeah.
So, like how do you get a broker to give you a deal without basically being an experienced operator already? Okay, so that's kind of tough, right? You go to a guy, the guy has a good one, and he says, well, how many have you bought? Well, I haven't bought any. So, okay, why should I show it to you as opposed to another guy who's just done 30 of them or something like that? That's kind of tough. I'd be curious to see what other people say about that. I don't really have a particularly good answer for how I myself got started, but you have to fake it until you make it. Basically, that's a good way to describe it. And get a couple of them one way or another and go from there.
I can tell you that's a very hard question, right? And we all have different answers to how we did it. But, you know, like Andrew touched on, I lost everything in 2008. I mean, I remember looking at my bank account, and I was trying to do development deals, and I was working through the recession, and I just knew something was going to hit. And so I looked at my bank account, and I saw $1,200. I'll never forget it. And it freaked me out. And I realized I had to do something different. I had to do something fast. And it's interesting. I got into apartments because I would go to these networking groups, and I paid, you know, $50, and I'd go hear someone talk on shopping centers because I was trying to figure out. I wanted to be a contrarian, right? They say buy when there's blood in the streets. Warren Buffett. So I wanted to see what were people buying in late 2008, 2009. So I pulled the speaker at the shopping center conference aside and say, hey, what are you investing in now? And he didn't want to tell me. So I stalked him in the bar later. I said, hey, you owe me an answer. He goes, I'm buying apartments. And apartments, you know, Jerry Springer, tenants and toilets, they say, right? So, and I had no interest because I had owned single-family homes pre-recession. It wasn't pretty. I had owned some duplexes and some fourplexes in horrible areas with no job growth because I thought they were going to be cash cows. It was all bad. I went to another conference on industrial, right, an office. Same thing. I pulled the guy aside, met him in the bar for a cup of coffee. What are you buying? I'm buying apartments. And that's what got me into it. But my first deal was an 80-unit deal. And I couldn't do it on my own. Someone else found it, put it in the other thing, I think when you start any business, you got to realize you can't do everything on your own. You need help. So in our business, there's three things. There's usually someone that has the ability to find a deal. Dave was starting to talk about the ability to communicate with brokers. There's another role, which is having the money, or the ability to raise money. And then the other role is the ability to get the loan. So I think start small and build the right team. But, 2008, again, I started with nothing. And it took one deal a year for 3 years to slowly start building up the business. And as Matt said, in the end, we're not real estate investors. We're all in the trust and track record business. It's really what it comes down to. People want to trust and believe in what you're doing. And they want to see a track record of success. That takes time to build up.
We talked early on about the quality of team that you build. That's actually how you get built bigger, is you just build a better team, right? And I know all three of you have partners in your respective businesses that have helped you to grow from there. So, Jeff, you had a question?
I had a question. All three of you are doing what I call short-term projects. Your timelines are, like you said, 7 years or so. When it comes down to winding down the project, how do you pay off your investors, and is there a way to do it without them paying big amounts of tax under today's tax laws?
Okay, so the question is when it's time to liquidate, it's time to sell, which I guess it kind of gets into how you structure your deals financially as well. So let's talk about that. So, Dave, why don't you go first on this and talk about, because you mentioned raising equity for deals, finding equity partners. Talk just on a very base level about how you structure your deals and then how you pay out your investors.
We give our investors a preferred return, and then we as the GP get a percentage of every dollar over that. Pretty simple. We've been doing the same basic idea for all the time we've been in business, 15 years actually at this point. And our current preferred return we're offering is a 6. We're probably going to take that down to a 5 pretty soon. And so we'll send out like an investment memo to people, and they'll respond back, describes the property, and not in great detail. They're all accredited investors. Now, with respect to the taxes, that's pretty tough. So we want to make money at this thing on the back end. And in my business model, we pretty much have to sell to make money, because in this market, there's not that much cash flow. You're buying smaller buildings. The total gross amount of money that these buildings throw off it's not that much, just total money. And when you cut it up between you and the investors, you're paying them a pref, there's not that much money for you to make. So you're forced to kind of keep these things moving. You're like a factory. You've got unrenovated buildings It's coming in this side, you renovate them and they come out this side. You take the investor money, recycle it into another unrenovated one, run it through the factory and recycle it again. Just keep going again and again. And as a sponsor, you're taking a percentage of the profit all the way along the line. However, every time you sell, you got to pay capital gains, long-term capital gains. You own it at least a year. I don't have a solution to that, to not pay the taxes, other than you can try to do a 1031. The problem with the 1031 is you got to get everybody to go together into it. You've got to find the upleg, which is tough because you have a limited amount of time to do that, and deals are hard to find. And then if you buy the upleg, now you've got the gain from the first one. You're probably going to have a gain from the second one. Then it's hard to sell, because then your tax liability, eventually you're going to sell. You could wait till everybody's dead and you could go on to your relatives, but that doesn't work so well. It's tough. It's just, I don't think there's a particularly good answer for that. The main thing from our perspective is, if we just sell quickly, we give our money back to our investors, they say, hey, that's great, nice profit, everybody. And then the next day, where's the next one? I might not have another one right away. So the problem for my business model is sometimes we feel a little bit like a hamster on a wheel, like you're always looking after the next deal, because if you're selling these things and running them through your factory, you might not have a bunch of them coming in on the other end. And you got to be comfortable that the money you're making on the sales might be really good, but it's going to last you a little while because you're never quite sure how it is. But then some years you might be buying a bunch of them and you're doing great. So it just varies, but I haven't figured out the way to avoid taxes and being able to turn them.
Mike, what about you guys?
Yes, I mean, before we talk structure, our goal is always to double our investors' money in either 3, 5, or 7 years. And it depends on the strategy. Every deal has its own business plan and its own strategy, but that's always our goal. And the foundation of that is also giving investors an 8 to 10% cash-on-cash return, or sometimes we'll use yield if you're thinking of bond-type terms. Our structure is not that dissimilar from Dave's. We do a 6% pref. We do a split of cash flows to investors. Every dollar that comes in, usually investors get 80 to 85% of that, and then we do a different split to the investors. Usually it's the same split as it is on cash flow profits when we sell. But to your point, 7 years is a long time, right? So I just told someone a funny story today. We have a deal we've owned in Texas, Tyler, Texas, wonderful market. We've owned it 7 years, and we promised them we'd return their money in 7 years, right? So we tripled their money in 7 years. So we've got a lot of happy investors. The loan term was 10 years. So instead of, exiting now, where investors end up paying significant dollars in taxes, and we don't want to pay a $400,000 prepayment penalty. We emailed them this week to say, hey, we're going to end up holding on to this property for 3 more years. That's a big deal, right? If we've been holding your money for 7 years. I didn't get one single response to the email. So, and we've been averaging 12% cash on cash to the investors. So what happens when you do 7-year holds, but if you've been successful and you've been doing what you promised and over-delivering to your investors, most of the times when that 7-year comes up, they just want to stay in the deal, which means you either refinance and you return investors' capital back and you hold on to it for cash flow, or you sell and you got to pay Uncle Sam. I mean, there's no way of avoiding that, or you can do a 1031. Which we're doing a deal right now. We've tripled the value of the property in 2 years, property in Kansas City. And we don't want to pay taxes on that. And our investors are patient. They want to stay in the deal. So we'll 1031 into something different. I can tell you know what we're talking about.
Another thing you can do too, like let's say he has 3 or 4 investors, he may know them pretty well. You can do a structure where you create a tenant in common. It's a little more complicated. I suggest hiring a lawyer with probably 20 years experience. So, cause they've been through audits, they've been through quite a lot. And then people can go whichever direction they want to go. There's time periods in which you need to have the tenant common in place, things like that. And so, for myself, I haven't had a lot of experience with raising capital with multiple folks to hold on to things long term. I have a couple, probably about 8 long-term projects, but they're literally like one investor, or 2 at the most, but the other person's kind of like a family member. So, but I will get to that point, and I'm planning on just paying the taxes. That's what I'm going to do, but I would probably do the same thing you've done if you have a term and it's more advantageous for a couple of years, making sure people are okay with that. And then one of the things too, I don't know how often you deal with this, and it wasn't really asked about, but sometimes it doesn't happen very often. Hopefully you can qualify people really well, but sometimes you get somebody who really needs to exit, like really needs to exit. Something happened with their family, cancer or something like that. And so you need to, in the back of your mind, your operating agreement should cover it on how that happens, but you should also have a personal touch and you thought through how you deal with that. That's why it's really critical as an operator, you have cash, you have availability of capital, because you will have to solve problems like that. And the last thing you want is a lawsuit on your hands. You know, always do the right thing, basically, right? And be cool. How have you dealt with that?
We've, believe it or not, we've never had an investor want out. But we get that when we have new investors. So we have a lot of investors. We just did a $9 million raise last week. Anybody want to guess the average investor amount? $9 million. 250. So it's 75,000. So it's a lot of investors, right? It's a lot of people. We rarely ever hear from these people. And only one investor has thought about getting out because, he's right. Things happen, right? Family issues, health, job issues. We say 7-year hold, but things happen. So it's a question that I often get with new investors. And it is harder to get out. But our deals, we have a wait list of investors for each deal. So we always have someone that wants to get into it. But with that, a lot of investors, some people go, oh, that sounds like a royal pain, right? Not really. Prudent real estate is about diversification, right? You're probably sick of hearing your financial planner tell you that for 20 years. But it's true. It's true. So that's what we encourage across we have investors that say, hey, we want to put $500,000 in the next deal. We want to put $1 million in the next deal. We don't really like that because apartments, I tell my investors all the time, and everyone, apartments are about smart singles and doubles. So if you know the baseball analogy, smart singles and doubles. Get on base. Score over time. If you're looking for a triple or a home run, you might not want to invest in the apartment world. So as a result, we have investors investing for singles and doubles. They're not going all in. They're not saying, oh my gosh, I love this deal. They're investing because they love the strategy. And usually if they invest in one deal, they're going to invest in 3 or 4 deals. They're diversifying their dollars across what we do because they believe in the business.
We started, question right here.
Yeah, just to follow on to that. Do your investors get a distribution always in the first year while you're executing your rehab strategy?
It's a great question. That's really hard to do in this economy. But yes, absolutely. We do quarterly distributions. Our West Coast deals, they're not getting 8% year one. They might get 5%. Our heavier value add deals, it's harder to do in the first year. Second year, we've renovated the units. We've increased rents, $100 to $300. We're delivering what we want to give investors, which is 8% plus. But the first year is challenging. But we've always delivered on quarterly distributions, even if it's a smaller amount first year.
And does it accrue? If you're only giving 5 in year one, are they accruing 3% later?
No. No, that's in their projection. We might say, hey, over 7 years, your average your average cash on cash is 9%, and your overall return on your investment is 20%. And they'll see in the projection, year one, our expectation might be giving investors 5%. Year two might be 8%. And then, upwards from there. And then we'll refinance, return investors' capital back, and then those cash on cash go down a little bit. And then, like with rents grow over time, investors' returns slowly increase over time.
Are you doing monthly communication, or is it just quarterly distributions and then like a quarterly statement?
That's a great question. We do it quarterly. Okay. But when you're managing people's money, it's a really personal relationship. So I'm on the phone with my investors all the time, as needed.
Right. I think most people, though, will report quarterly, especially if you've got that level of investors. It's too hard to do that monthly.
We do quarterly as well. Same thing.
Let's talk about acquisition. So I know we talked a little bit about brokers. Andrew, how do you guys find deals? Like, how do you find the land that you want to build on?
I think everybody kind of starts by looking at the multiple listing service, right? And then you start to dig a little deeper. You start to look at frequency in which people have sold stuff. Having a good relationship with the title rep is like super critical. People that can help you kind of scrub through the information, and you're seeing what things are transacting. You're like looking in the neighborhood, and all of a sudden, like, there's like this same group that's bought like 10 things. You're like, how the hell did that happen? Didn't even hit the MLS, right? Start knocking on the doors. You have to get real scrappy in this business if you want to find deals. And so I had the same question for somebody when I wanted to start getting into back into this business in 2010. It was like, how do I build deal flow? No one was taking me seriously on the phone. It was really tough. And it's like, no, you just keep at it, you keep at it. And all of a sudden, yeah, you just keep at it. Something comes up, a good deal, and then you just try to sell them on who you are, and you're persuasive, you're persistent. It's even harder nowadays. Finding off-market deals. The only way you really find off-market deals is by building that relationship with the broker, and keep it, right? Keep that relationship. And sometimes, like, I promise people the listing on the back end, and I stick with it. And if I don't stick with it, well, there's a problem with that broker. And I generally, like, they usually feel good about who you are, but the only way they can really trust you is you have knowledge. You have to really know the market. You have to put in the work. You know, before I bought my first condo, I had seen like over 300 homes. I'm not shitting you. I really had. From houses, single family homes, to condominiums, right? And so I wanted to learn where I wanted to invest. 'Cause like you were talking about what direction. At first I was just jamming on 2 units and 4 units. That's what I want to do. That's what I want to do. But I couldn't make the numbers work. I couldn't make the numbers work in 2003. I just couldn't. And then I saw the gap in the market in Long Beach, 90802. That's where I started. And I saw this gap in the market on condos. I saw a spread. I could buy something for 170, 180. I could sell it for 250 to 280. And I could put $10,000 to $20,000 in. I said, okay, I'm going to do that for a while. And I did. And that's how I kind of built up experience. But then all of a sudden, people start seeing you do deals. And then, it just starts happening. People start calling you, and you got to go to events like this, and somebody feels confident in meeting you, and all of a sudden they call, or you follow up like, hey, I wanted to see if something came across your desk. And all of a sudden, one of you may have had a water cooler conversation about a deal that came up, and he thinks about you because you just bugged him 5 minutes ago. I swear, this is nobody's going to believe me in this room when I tell you this, and the people who have the experience are going to totally understand this. You can be dealing with a broker you call that has 10 really great clients that regularly buy from them, and I swear, if you call them at the right goddamn time, you will get that deal just because, I just got this deal. It's unbelievable. It's unbelievable. Like, seriously.
Works the other way, too. I found when I sometimes I'll see a good deal on CoStar as a comp, and I'll think, well, how come I didn't see that? And I call up the broker and say, how come you didn't show it to me? And he says, some other guy called me, at that particular time that he had it. They're like lazy, right? Whatever's in front of them, they'll say, I'll call this guy.
I think we'll all say in the end, we're all in the needle in the haystack business, right? You have to be really good at what you do to find really good deals. And we don't do a lot of them, in the scheme of how many deals we look at. So to your point, I always say we buy, we have to thoroughly analyze and due diligence on 100 deals to get one. And, we'll have done 4 deals this year. So, I'd say we've looked at more than 400 deals to get one deal that works. And there's so many ways to get opportunities. But yeah, you're right. Sometimes it's just calling at the right time. But it comes down to relationships, like anything else in business.
But you're all dealing with brokers. You're all finding it through brokers. You're just trying to find off-market stuff or stuff that they just recently found.
Yeah, you just have to have as big a network as possible of brokers within the geographic areas that you're interested. And I think if you're interested, like in this market, you got to kind of know which ones to follow. Some brokers I find will just take listings and they'll just try to get the absolute highest price for their owner. Okay, so that sounds right. It's what typically we're supposed to be doing. But as a buyer, you kind of want to get something that might be a little bit better. You want to make some money on the buy. So you kind of have to get a feel for which brokers are going to be connected with a lot of the kind of mom and pop owners who have low rent, as opposed to the brokers who are just trying to sell stuff that, like, I've fixed up and is already maxed out. Because you don't want to buy something like that. You're not going to make any money on that. I'll just tell you a really funny story with one of these guys who, and this is the guy who I've bought a few interesting things from. This is years ago. So I was meeting with him in his office. He's a realtor and, occasionally sells apartments, sells houses, talks to a lot of people. He says, oh yeah, David, just pretty soon, just hang out. It's going to be a couple weeks. I know this elderly couple, and the husband's doing kind of bad. He just went into the hospital. Looks like there's going to be an opportunity to make a deal here. So a couple weeks go by. I call him up. I go, hey Jim, what happened to that 20 units you were telling me about? It sounded like it was going to come up. He goes, oh, the guy got better. That just goes to show you how people think.
What David just talked about, is like the secret. What he just told you right now was one of the biggest secrets on acquisition that anybody can tell you. So to kind of take it another step, right, in your local area, wherever you're kind of like want to focus on, find real estate agents who maybe don't do like a ton of deals, but they're older. They have those folks who call them, hey, I'm thinking about selling, what are you thinking? Let's sit down and go to their living room table. They don't do it over the phone. They don't send an email, right? They are gold mine. And guess what? They want to double in the deal. They don't want to deal with somebody else. They want to close the transaction. Yeah, they'll sell it for cheaper. And all of a sudden, they'll bring another one. They'll bring another one. And they'll bring another one. But you take really good care of them. And you give them a listing back, or you do something for them.
Yeah, exactly. You hire them when you're done. When you go to sell it, you can hire them, because then maybe they can get, like, I like to call it a quad for those guys. They get two ends of the deal. When they sell it to you, they represent you as the buyer, they represent the seller. Then when you hire them to sell it, they represent you as the seller, and maybe they can find a buyer. So they get four ends of commission on one property in a relatively short period of time. But, the other thing is, when somebody shows you something really good, you have to be really, really ready to actually close the thing. You don't want to fumble it, because a lot of times when there's a good opportunity, a broker will have one shot to get the deal done. If it brings it to you and you're a closer, good. But if you goof on it, they're probably not going to bring you the next one.
And I think it's important to note too, when you're dealing with, all these different brokers, being able to talk with them intelligently about the actual deal and showing them through speaking with them that you can, talk with them in their language, with the right real estate jargon, with the right cap rates, and telling them the things that they want to hear, like, you already have the backing, you've gone through this many transactions, you've have this system set up, or this system set up, or this much of a track record. It's the same type of thing as if you're raising capital, you're dealing with the brokers on that aspect as well. And that being said, the brokers are a great strategy to use, but you have to also develop the relationship with them over time and continue to hit them up. It's almost like a complete sales system, right? The 12th hit, they know they're your best friends, right? So you call them 12 times every month, for the entire year. That 12th hit, they're going to feel like they're your brother at that point, They're going to be talking to you like, okay, yeah, no, I don't have anything. And after you actually close that first deal with that broker, they're going to be bringing you those deals, because so many people don't close. If you go through and close a few of them with that broker or in that market and show them, hey, I closed these ones over here, go look it up, that shows them that you're real, because there's so many people that aren't real. And there's so many people that just don't have the bandwidth to actually take a deal down. So in addition to that, I wouldn't discourage you from trying to hit up the owners directly. Yeah, there's LLCs in place. There's, things that you have to go find that owner. There's more work than a single family home owner that you can go find, but it's a lot easier where, there's a lot more public records are easier to find than than an LLC, trying to find an owner of an LLC, but you can skip trace them and find that information and constantly be hitting them up. This is what, we were talking about this before. This is what brokers do already, right? They're already going directly to the owners, trying to find these people and trying to actually do that work for you. At the same time, and from my standpoint, you can get much deeper discounted deals working directly with a homeowner than you can with a broker Sometimes. You can always find good deals if you have good relationships with these guys. But when you're dealing directly with the homeowner, you're dealing with somebody that may not necessarily be as educated about the correct value or all the value add potential that can happen about this, which kind of leads into the next point that, we should be discussing, because we don't have a ton of time left, is the value add and property management standpoint of this. What are the things that you guys do from an efficiency standpoint, from a value add standpoint, that make you valuable, that bring the things that, what are you bringing to the table as far as value add that is going to make this project viable? And the property management side, how do you run that efficiently and make that, really viable? Dave, you want to start with this one and then we'll...
Yeah. The good news as your potential apartment investor in this area is that the supply of poorly run apartments in Southern California is massive. There are so many poorly run apartments around here to keep everybody in this room busy for 10 years. 10 lifetimes. There's thousands of them all over the place. And the trick is to find them. And when they float to the surface and become available for sale, you can buy them and you can turn them around. It's mind-blowing to me. I'm sure Mike and Andrew would say the same thing. How badly managed properties are for apartments around here. And I keep thinking, why is that the case? Not to digress too much, but I think Prop 13 has a lot to do with it. People have these very low tax bases because they've owned the property forever and they can cash flow at rents that are way below market. But the management aspect, we hire a third-party management company. We kind of explain to them what sort of a renovation program we want to do for our property, and we'll give them the specs on what to do in terms of renovating the interiors, and we kind of have a fairly straightforward approach to it. We'll do a little bit of exterior work, might paint the building, put up a new sign, renovate the interiors really extensively, because that's what people will pay a premium for, is nice interior stuff. Laundry, all the usual stuff, cabinets, countertops, anything they can touch. We try to improve that and try to get the best rent we can when we have a vacancy to turn over. And the trick here is that in LA, the multipliers, because the properties are ultimately valued as a multiple of their income, the multipliers are maybe 15. So every dollar of incremental income that you can add to a property around here through your renovation program turns into, theoretically, $15 of value that you're adding, which is extremely powerful. If you just go and raise everybody $100 a month, I can't do the math in my head, but if you do that 100 times 12 times 15, it quickly adds up, and you multiply that by the number of units you have. And then you find these properties around here that are just pathetically managed by people, and that they might be $1,000 a month below the market. So 1,000 times 15 times 12 times, it adds up really quickly. It's extremely profitable business if you kind of know what you're doing and you know what the market rents are. And the variable that I pay by far the most attention to is, once I get the building renovated, what rent can I get for it? Because that kind of sets the upper bar for how much it's going to be worth and how much cash flow the thing will ultimately generate.
We look for, again, properties, good access to employment centers, good walkability, good access to mass transit. But for the most part, we're providing safe, updated housing, number one. So from a management perspective, as Dave said, there's a lot of mismanaged properties out there. And that's what we want to buy. We want to buy these really well-located properties that have been owned by the same group for 50 years and managed by the same manager for 20 years, and she's 70 years old and she's ready to check out and retire, right? We love that story. And we'll go in, we'll bring in, we use third-party management as well. We'll bring in, we work with two of the top management companies in the country, and it's customer service, right? In the end, people want to know that they're cared for. They want their repair requests, what we call work orders, to be taken care of in our business within 3 days. That's a huge thing in our industry. I look at that every week on every property. If I have work orders outstanding over 5 days, I'm upset about it. That's what keeps people in our properties. But for the most part, and from a management standpoint as well, we make a lot of money off good management. On top of a good manager bringing rents up to market, we have a lot of pets. When I first got into business, I didn't want pets in my apartments. The reality of it is 30% of renters have pets. So realistically, you want to have pets because it opens more doors for more opportunities. So, we're charging $300 non-refundable pet deposits if there's a problem. We're charging pet rent of $30 to $40. I told you earlier, we're putting in pet parks and obstacle courses. These are the things that, people want in a community where you can get it. In LA, it's hard. You don't have that sort of land. Yes, sir. The reality of it is pets cause less damage than you think. We actually don't even have a weight limit any longer. We do have a breed limit when it comes to pit bulls and a couple other breeds that we won't permit. We are doing vinyl plank wood, more because of the cost of it than the pet issue. But you guys have seen it, right? I mean, vinyl wood, even vinyl sheet nowadays, it's hard to tell from real wood. But that's a great question. But management, especially on our larger properties, with amenities and services, and Starbucks in the morning. We have I bought a 40-unit property last year. It's one of the smaller deals. I'm giving out turkeys to every unit for Thanksgiving. It's only $20. And people will talk about our property and how we manage it and own it for years, and they're referring people. And sometimes it's little touches like that make for a great apartment investment.
An actual turkey or a certificate to go to like a supermarket?
That's a great question. I've done the actual turkey before, and there's some logistical issues with that. So now we are doing a certificate.
Let alone liability. Somebody gets sick off a turkey and you're getting sued, and make them go to the grocery store and buy it themselves.
But I remember here in LA, Fiedler Engineer. I used to be a civil engineer for a lot of big developers, and I remember that engineering firm. That was their thing. They gave all their clients a real turkey. And they would drive to us and deliver it in dry ice, and it's such a memorable thing.
Yeah,
right?
you're not going to forget that as a tenant if your landlord buys you a turkey.
Your landlord cares about you, right?
Yeah, exactly.
So little things like that go a long way.
Yeah. Yeah.
In the city of Los Angeles, there's there's most of the units that are out there under rent control, and so it's there's some really amazing groups out of Orange County that have come in, and they do a job that I won't do. And they'll come in and they'll aggressively do cash for keys and get the tenants out. I just not really interested in that business too much. It's a tough business, and it's really hard sometimes, and it's very litigious oriented long term. But you can find units that have a few vacancies, and you can take a long term approach, and that can be very rewarding. One of my good friends is also somewhat of a mentor of mine. Timing was good. 2010, 9. He was buying a lot of properties in Silver Lake and Echo Park, and I was like, "Why are you doing that? Oh my gosh, you've got all these tenants." He goes, "Andrew, people get married, change jobs, do this. Not everybody's going to stay put, even though they're paying $500 a month. They're going to leave a place that can rent for $3,000. They're paying $500. They're like, yep. They just have other things to do." And I go, wow. And then sometimes he'll even show up and he'll literally say, "I have a special this month. I'm giving $10,000 to whoever wants to move out, cash." Right? And he'll put a note on each person's door. I mean, really, you can get aggressive with it, right? So there's different strategies that are out there, right? I'm not as interested in doing that. Maybe longer term on something that has a lot more vacancies that's available. Because it's becoming very, very political in Los Angeles, and you have to be very careful. You can't just make these bold, like, this is what we're going to do. And you have to be sensitive. Like, I don't like evicting people. That's not what I'm interested in doing. And I do have to do it, guys. And I have to do it when I build new apartments. Sometimes there's a duplex, and I'll have to, one person I give cash for keys for, and the other one's like, I'm going to, fight you till I die, sort of thing. And then we have to use something called the Ellis Act, and then we get them, and then we offer it to them back when we build it up. And when we put that into our financial equation, right? So there's different steps, but when they turn the units over, and when I turn the units over, the typical amenities, a lot of people are trying to do things like building decks on some of these older units that are built in the 40s and 30s. And so they're trying to create amenities, even though there's tight spaces, to create decks. They're using they're using pretty lights above there, providing a barbecue as much as they can in the small spaces, because it makes somebody feel like there's a little more lifestyle that's available. And the biggest thing is the washer dryer and the pets, if you can provide pets. Now, some of the bigger apartments that I have in development, I have one that's 45 units in Hollywood, and I'm going to be serving free coffee from 6 till 9 a.m. on Wednesdays with a truck, like on the rooftop deck with like somebody serving cappuccinos, and then I'm going to have yoga on Saturday mornings, right? In a big space, just dedicated, stylized for that, and then I have building out the kind of a whole area just for a big area for dogs for people to go to. And then when I do my gym, I'm doing my gym on the ground floor, and I'm opening it up because we're there in Southern California. So all my windows open up to a big courtyard, so people can do kind of CrossFit training related, work. And so, and I'm not going to be charging crazy rents like they have. I'm going to working class folks, but I want to have tenants, and I want people to talk about it. And I don't know if you're doing this, but I'm planning on each of the bigger apartments that I have launching, regular marketing campaigns online with social media, and I'm designing all of my buildings so that it's I know it sounds really cheesy, but Instagram friendly, right? My wife's a social media consultant, and she's really good at that stuff, and designing things to where people just are intrigued to like share it with everybody. It's like this incredible experience you give to them, and sometimes it doesn't cost a lot of money. It's amazing. Just something thoughtful and creative.
So say one more thing on property management companies. Man, they make your job a lot easier, right? You talk about liability issues and like legality issues and eviction issues. They know it. I like to think they know it better than I do, and we do. They're trained to close people. They're trained on leasing. Especially some of these bigger companies. Social media is huge now, right? I mean, so many people are renting online, and they're looking at reviews. Some of those reviews are legitimate, some aren't. And there's a whole management process of needing to go online and stay on top of it and have tenants putting good news on social media. So all that's huge. And when you're working with a professional group that understands that, especially when you're getting started, it's a tremendous benefit to you, and it's safer. 3%.
The question is, what do you pay your property management? 3%?
3% of net income.
Plus acquisition fees for new tenants?
No acquisition fees.
Speaking of property management, I mean, that's clearly, you guys are specifically in the business of having to manage your property managers. So you mentioned about keeping an eye on repair orders, making sure those are done in 3 to 5 days. What are the types of things you guys do on a regular basis to make sure your property managers are doing a good job?
I go out to the properties and visit them periodically and take a look. I'm more focused on the renovations that we're doing and how the units are getting done in terms of a timely fashion and with a great attention to detail. When you're trying to rent for premium rents, you got to offer people like a perfect place, and you can't have a lot of junky work done on the interiors. It's got to be done really well. So I'm probably more focused on the renovation than the kind of day-to-day work of leasing and maintenance and that kind of thing. I'm a little more back-end focused, so I want to create this product that'll be valuable ultimately to sell in a few years. The intervening cash flow and whether the management company is doing a perfectly good job on maintenance and tweaking every expense, I'm interested in that, but probably not at the absolute highest priority. But it's definitely good to have a management company that you think matches up with kind of your approach. You don't want to hire some company that's too big, because then you'll be too small for them. But you don't want to hire somebody too small, because then they're not big enough to handle what you want to do. So it's tricky. I mean, you might have to go through a few of them in order to find a group that you really like and who'll pay attention and get the things done in a timely fashion.
Yeah, to Dave's point, especially on the renovations, you need to be there. We have weekly conference calls We're on site. Even my properties that we've already renovated and we've owned them for 3-4 years, at least twice a year, I'll show up in my Aloha shirt, my flip-flops, unannounced, to, keep my staff, on target. And then weekly we have what's called Monday morning reports. So we've got 16 properties right now. Every Monday morning, by the end of every Monday, I'll have a report that goes through a number of issues. But some of the things we always look at, what's the occupancy? What's the economic occupancy? What's the physical occupancy? A number of work orders over 5 days old, and delinquencies, which is late rent. Those are some of the big 3 or 4 things we focus on.
Andrew, how are you keeping an eye on? I mean, you're building. You've got multiple projects running at the same time. How do you keep an eye on the crews that are working and make sure things are being done as you envision them?
I think we have a good team, and it takes a long time to build a good team. In fact, we passed on a lot of projects because we didn't want to take on something we couldn't do a good job on. I mean, you have to kind of sort of know your limits. I mean, right now we're hiring 2 superintendents, 3 junior project managers. I mean, I might hire a senior project manager. Depends if they're good enough. And we're going to have one guy got promoted today, and so you have to constantly be looking for good talent. I mean, you never know. I may meet somebody tonight that's a great fit for us. I mean, I may meet somebody at Starbucks. You never know. You just have to keep your eyes open. We couldn't do this out of team. On my schedule, I have something a little similar. I can't, with there's so much development going on, Mondays kill us. We're kind of buttoning up loose ends on Mondays. Tuesdays are when we have our internal meetings. And then we have a deep dive typically on Wednesdays, and then Thursdays mornings. And I'm really focused on just all out details of the interiors and details of the exteriors and the architecture and just like the development side. And then I'm in the field and I'm looking at the projects and I'm walking it with the superintendents and I'm walking it with the subs and I'm going through the checklists and we're just and taking a lot of notes. And then on Saturdays, I'd sometimes, if my wife doesn't yell at me, I'm regrouping and kind of, putting it all together and looking at the reports and we have to have standard reports every week coming back from the folks on our staff that are the management so that we're looking at the right data, right? And then right now we're having severe problems with labor shortages in Los Angeles. It's absolutely catastrophic. And, we've been working with subcontractors for a lot of years. They've stayed loyal to us, and they've done well on the pricing side. But our lumber costs have gone up there's so many areas of costs that have gone up. So you constantly have to kind of manage to them and do the best that you can. But it's we can't do this business without a good team. It's absolutely, you can't do it.
All right, last question we're going to ask, and for each of you guys, try to give this one in 60 seconds or less. What's the biggest mistake you've made, and now that you know, what you have done differently, either when you just started or, kind of midway through your careers?
I'd say the biggest mistake that we made was coming out of the recession in about 2009, 2010, 2011. We weren't as aggressive as we should have been buying stuff. When things were cheap, on a relative basis around here, I can think of a lot of things that I looked at on the computer that just looked like, it doesn't look like it's good enough. I'm too afraid, maybe the economy's not recovering fast enough and what's going to happen. I should have put the pedal to the metal. And at that point, you got to go for it. And, that was probably the biggest mistake we made, was not being aggressive when there were good opportunities. Now, the market's all gotten really high, and, it's easy to look back and say, wow, I should have bought back there. But you need to be looking forward. But anyway, that was mine.
Mike, what about you?
Yeah, mine has been trying to do too many different things between single-family homes and private lending and development and value add, and many of you have learned about all these different opportunities, and there was a while I was doing a little bit of all of it, and it wasn't until I said, hey, I'm going to focus on apartments and become an expert at that. And you'll see all of us, we all do something different, and we all do it really well. It's carving out that niche. But when you're trying to learn something, Once you find what you like and you do some research on it, don't overanalyze it forever. Just try to pick one and become an expert at one thing. And that's where, personally, I've had success.
Andrew.
I think one of the biggest mistakes I made was when I did a project in North Carolina. I had a really capable person on the ground. But I tried to use my California, like Los Angeles mind, right? And we did a great job. It looked so gorgeous. In fact, someone from Hermosa Beach bought it. So, hey, right? We built it too small. I should have done like 2,000 square feet bigger, right? Seemed like a great opportunity in the best neighborhood on the best street there was, right? But it was like I was so presumptuous that I can like just figure that out, right? On the development side. And that's different on the apartment side. I wish I had bought apartments in that same city. That would have been a much better opportunity. But to get back to what you're referring to, like one of the reasons why I don't do small lots anymore. I'm building them out because I already got them done. But on the development side, I'm just focused on apartments. Just zero dead focus just on apartments. And then maybe I'll have opportunities to buy stuff that's already available. And that's all that I focus on. And you finally figure out really where your strengths are. Because I look back historically and all the duplexes, fourplexes that we've done, and I go, wow, we did really well on those. And what was nice is they cash flowed really nicely while we were in the position. A good analogy to this is in Boyle Heights, I built a 4-unit complex, and everybody thought I was just absolutely crazy that we were going to sell this thing for $1.5 million, right? Yeah, good luck, buddy, right? But we were renting them for $2,600 and $2,800 a unit, 3 bedrooms, 2 baths. We put them on the market, they leased immediately. They were folks that were originally looking in the Arts District in Los Angeles, right? But during that time we were waiting, we had no problem. We were getting incredible rents. We were like, no problem. So it's those kind of deals sometimes you wake up and you go, hey, I thought I liked this business. I really like this business now.
All right. Well, we're going to go ahead and end it. Thank you, guys. Let's get a round of applause for these guys.